I actually got into 4 positions, but I only posted 3. First one is Johnson Johnson. Very straightforward here. If you guys remember one of my Twitter posts, I talked about Johnson Johnson, how this thing has been stuck in this channel for quite a while, all the way since 2021. And now, after we rebounded from the bottom of the channel in January, we have a potential to break out of here. So I really like this trade. I really like the 30-minute 2 as we kind of closed above the channel and we kind of closed a little bit strong. Sorry about that if you hear that. That's my dog playing around with his toy. Yeah, so we got Johnson Johnson calls. I think I'm aiming here for 189. That's where I'd love to leave my runners for. But 170 is definitely an easy target, I believe we'll find. I'm going to explain why I got into these positions in just a second. MRK, Friday I got MRK calls, but that was like really near the close of the market, and almost nobody got into it. But I got into them again, and I mean, it's pretty simple here. It's just this gap is just too huge and too easily accessible for me to ignore. So that's why I got MRK calls. And obviously both MRK and Johnson Johnson are in the health sector. GIS, which is General Mills, there's 2 reasons why I got this. One is because of this daily setup. You know, you could easily eye this trend line over here, and it's attempting to break out of it. So that's the reason why I got GIS. And then I also got Coca-Cola. Had an insane day on the daily. You could see it was a pretty big day on the daily, and the 30-minute just looked great. But the main thing is, why did I get into quote-unquote slow movers, right, and low beta? Well, this ties into exactly what we talked about last Monday. And I've been getting a lot of questions for people who were ignorant enough not to watch that video to keep on asking me why I'm not taking stuff like NVIDIA calls, Meta calls, TMC calls, or, Amazon calls. And it's fine. But the main reason is because I like getting into swing trades that allow me to keep my runners, because I am a person who loves keeping the runners. And obviously, even though it's a risk-free runner, I try to size into a risk-free runner after the trade is profitable. I'd rather that trade, continue in profit versus it losing all of the value, right? So I want to get into trades that will last longer. And when you look at all these other stocks that are high beta, such as NVIDIA, Meta, Amazon, all those kind of stocks, they're all descending in price. Though they're no longer bullish, right? We're no longer in a bullish market. So where does money rotate in a bearish market? Well, it rotates from high beta to low beta. And also additional to low beta, they get into stocks that are called safe havens. Well, what are safe havens? Safe havens are stocks where even in a recession, it's not going to 100% be foolproof, but those stocks consist of, it requires the sale of goods or services that are still needed every single day. So, the whole quote is like, if a recession hits, right, no one's going to stop buying toilet paper. No one's going to stop buying, it's going to be hard to buy medicine, but no one's going to stop buying medicine. No one's going to stop buying cereal. So that's why you start seeing these lower beta stocks kind of, get some momentum here. And what usually happens before a bear market is these stocks have a significant rally. And of course, they do eventually fall, a decline in price, but there's still that rally in the beginning of the bear market because money is pulling into it. And during the bear market, since there's so much money in it, those stocks don't lose significant amount of value compared to the higher beta stocks, because the smart money or the bigger money is not in the higher beta stocks, so they won't be consistently getting in and out. So that's why stocks like NVIDIA, Amazon, maybe Apple, Microsoft, and those kind of things, they will get severely impacted. So that's why I've been, over the course of the past 2 weeks, trying to get into lower beta stocks such as Coca-Cola, Pepsi, Walmart, Disney. We got into Disney calls. Those only went like 30-something%. But Yeah, I mean, that's why I got the swing calls here. So before I continue and before I hand it off to JP, you guys can go ahead and ask whatever questions you want. This is going to be regarding everything or anything, as long as not personal. And we will try answering to our best ability with our opinions and experiences. But I mean, you might as well make use of it because people charge. I even charge. We both charge money for one-on-one. So instead of doing that, you guys have the opportunity to ask now. If your questions are related to topics that are going to be answered in the future, still ask it. I'll answer it briefly, but of course, if I say we're going to go over it in the future, I'll make sure to do a deeper dive into that. But before I get into the questions, JP, I want to ask: is there anything you want to talk about, or?
I mean, I took a couple of trades today. My limit orders didn't get filled. And this morning when you and I were going over trades, I want to take Occidental, Oxy puts. Um, and I don't know if you want to pull up the chart. I saw the breakdown happen in front of my face, and I put a limit order in, and I was like, oh shit, I filled it, and I didn't fill it, and then it just completely died, and I was super upset about that because that would have been over a 300% trade. I blame myself for not hitting a market order. I even said it when we were talking. I'm like, I'm gonna go, short here, and you're like, why are you filling a swing? It would just had a technical breakdown below a key level of my SMAs. Actually, if you turn on your SMAs, I don't know if you have that indicator on that I told you about. No, it was the daily moving. Remember the one that I use from
Uh,
it's daily SMAs from a guy called Immortal Freedom. If you pull it up on your indicators, if you just look for it, you'll see exactly what I mean. So just put the number, just put daily, and then type SM. There, yeah, there we go. Yeah, that guy. So you see, there was that technical breakdown below that. I don't know what level that is for you, but for me, that is I'm sorry, because of the color scheme. So we basically broke down below the 20-day SMA, and it just took a dump, and it held support there, but it couldn't get above the 50, and it's just another key SMA breakdown, and it just went. But that was upsetting, and it went straight to my target. My target was 56.13, and literally it broke underneath it but for a couple of cents and then just came right back above it. So that's kind of upsetting, but it is what it is. Kratos, KTOS. Um, you know that I've been in that since last week. I actually am very happy at what it's doing, even though we're in like this very bearish market that everything seems to be selling off. Kratos is maintaining above the 10-day SMA, which is at 25.83. And it actually pulled back exactly how I thought it was going to pull back. It pulled back to its level. It held, and now in the after hours, it's trying to get back above that level that I have at 26.32. I was in shares, so I did sell my shares, but I'm still holding the January 2026 calls. They were up at one point. They went anywhere from like 10% to like 30% because of the spread. But right now they're only up 3%. And like I said, I like being in stocks. I like being in trades where things are breaking down, but they're holding. You know what I mean?
yeah.
So there's a I use a 130-minute chart, and I know you use a 2 hour, but if you grab the 2 hour, you'll see that there's a trend line uh that it's following. No, from bottom, but yeah, exactly. Yeah, yeah. It's following that trend line. And I wouldn't get out of this trade unless it like broke and closed below it and it couldn't get back above it. Um, I still think it looks great. My ultimate price target is above 30, and I have a year on this contract, so I have nothing to worry about. Um,
How much did you say you were up
I
again?
what'd you say?
How much were you up on those contracts?
At one point today,
Yeah,
like 30%.
it's pretty nice for a leap.
Yeah, like
Yeah.
because the spread went nuts. Um, and I actually could have put in an order, and I think somebody would have filled it like at $4 or something, or 4.10, whatever it was. I don't know, but at the end of the day, we both took Merck, and I was telling you, because you wanted to take Johnson and Johnson, and I told you, dude, I like Merck more than Johnson and Johnson. I didn't take Johnson and Johnson.
Wait,
I
what? You
just think
didn't?
that Merck has a better setup because of that gap that it needs to fill on the daily. So I took that, and then I didn't even hesitate with General Mills. I took General Mills like I saw it. I've been talking about it.
Yeah.
You brought it up again, and I was like, okay, this just looks good. It did. I have the same trend line. It's literally the exact same thing. So when we both see the same setup, it was a green light for me. And then I have one more that I've been watching that I didn't pull the trigger on because I wasn't too sure if I wanted to swing that many positions. Nextera Energy, NEE.
I was looking at that as well. I like that.
And you know that I love trading the stock. I love it off the 130 minute.
Yep.
Um, if you look at the 65 minute more than anything, which would be your 1 hour, the 65 minute is a little bit cleaner. You'll see that it's gonna try to break above those wicks of those previous 1 hour candles on the top of it. Yeah, exactly. So it got above it. On the 65 minute, which is why I really like to use it, it literally it wicked right off a 65-minute level. I want to see if it comes back down to 71.34 and then it can get back above that 71.68. And at that point, I'll take calls with my ultimate price target being 75.85, which is the 200 SMA on the daily, and it's also a level I mean, you could eyeball it, the 75, 76 range. You see that level?
Yeah, yeah. The funny thing was, I was actually going to be filling positions for my long term throughout this live session,
Yeah.
and Nextera Energy was one of them. And I'm glad because you've been eyeing it for a while now, and a big reason why JP eyes is because it is also low. It's considered a safe haven because of its dividend yield and a stable price. So money does rotate into it as well. So yeah, I like it, JP.
Yeah, and I mean, other than that, I have no shame in the game saying it, but last week was the end of my Top Step account, my funded account. Um, I was on a micro trade on NQ. Um, and if you go back to Thursday, you can see exactly where I got caught. Um, and it was just a straight free. I put so much effort into that account, and I was like, oh god, I don't even want to worry about it because futures are moving so violent right now in general. You know what I mean?
Yeah.
It's up 50 points, down 50 points. It's like I just don't want to deal with it. I just really just want to play single stocks and not be worried about whatever happens in any other session other than the cash open at New York. And one last thing that I've been watching that no one has been paying attention to, but I have is Bud, BUD, which is Budweiser, Anheuser-Busch. So it had this massive gap up, right? And oddly enough, it's been doing this weird thing where it can't seem to fill this gap all the way to 62, and we are very overbought on it. Um, I want to see what it does in the next couple of days. If it fails to get above 60, 62, I'm going to be looking to probably fill a short on this
Gotcha.
because of that giant gap down. It just feels like it's an easy play if it fails, right? And it has that gap all the way to 54. Um, I was also looking at Pepsi. I really was Pepsi was like my number one trade up until I saw Merck, and Pepsi just looked incredible. It looks incredible on the daily. I don't know if you were looking at it today.
Yeah, I was. I ended up getting Coca Cola over it.
It just looks so good. And I mean, it's ugly. I mean, you're gonna judge me for what I'm gonna say, but it's like it's got that little it had that little W formation. You know what I mean? You see that?
Yeah.
See that double bottom W formation, and I just think it's gonna just bust through that trend line and ultimately go for that 161. Ideally I would love to for it to go to 180, but I don't know if we're gonna get there because I feel that by the time I feel that at around 165, 170, it's when we're gonna see it pull back. You know, so I think we can get a couple like maybe five to 10 points out of this in the next couple of weeks.
Gotcha.
You even have that volume shelf on the daily there, so you can see it. That probably lines up with the 170 if I'm not mistaken.
Right. Yeah, so glad you get into the questions here, so you guys can
Yep.
put them into the chat and we'll answer them. Um, Again, if I give you a brief answer and I tell you why I'm giving the brief answer, it's because we're most likely going to go over it in the future. But yeah, oh, it's funny, actually, it's great that you're on here. Walmart was always considered a safe haven, but the
Not
funny thing,
anymore.
yeah, not anymore, that's the thing, because it has just been skyrocketing for so long, and it's not had a true retracement that this stock is not really, you just can't really consider it a safe haven anymore. I mean, now it technically moves. As funny as it is, I don't know if you guys have been observing it, it actually moves along with NVIDIA sometimes. So, yeah, misconception is people think Walmart and Target are safe havens. No, not really, not anymore. But yeah. So, somebody asked, how do you develop better trading mentality? Do you have any books you
Oh,
can recommend? Um,
they lose a lot of money.
the simple answer is just over time, you kind of have to ground yourself to the reality of stuff. This also will tie into a lot of things that we'll talk about on Thursday. You have to figure out what your expectations are and what. First off, and you'll see me talk a lot about this on Thursday because it's very important. You gotta first realize and figure out why you're trading. If you're trading to just make a quick buck, you might as well leave the live session right now because I can't help you. Um, that just can't. There's nobody who succeeded that way and thinking that way. So you have to figure out what the true purpose of trading is for you. It could be something as small as just having, a small side income on the side versus being a huge part of your income, in your life, right? So you have to figure out what your expectations are. You have to figure out what your financial situation is. And then according to that, you can figure out what you want to do. And when you figure out what you want to do, a lot of the emotions get out of your trading. That's just what I've seen from my experience and other people's experience as well. The reason why people end up getting so fearful about their trades is because they don't plan. And this could be as simple as not having a clean chart. This could be, it could be a crowded chart. It could be that you just turn on your screens and then it's already market open and you're just trading right away. And if you don't have any proper planning beforehand, how do you expect yourself to consistently succeed, right? It doesn't matter if you succeed a few times. It matters that you consistently succeed. So it's like if it takes 11 years, almost like what, 7 or 11 years for you to become a doctor, right? That's 4 years in college, 4 years in med school, so that's 8 years, and then 3 years in residency, where you get a $200,000 to $500,000 salary. If it takes that long to become a doctor, why do you think that trading can somewhat replace that in not even a short, any compared time, right? So you have to realize that if you see someone succeeding and they didn't really put time into it, I'm not wishing bad upon them. God willing, they continue to succeed. But statistically, they're not going to be the ones who consistently do well. Meaning, you probably won't see them a year from now, beating the market, quote unquote, as they are right now. So if you have a plan, things become a lot easier, at least in my experience. And this again ties into the risk management thing we're going to go over on Thursday, and I think it's personally one of our most important ones because I'm going to hit a lot of facts that people don't talk about. But there's different ways you can trade. And what I mean by that is when it comes to sizing, there's different approaches. You can either size in such a way that it's quote unquote small, but you allow your trade to develop. And when you allow your trade to develop, and since it's a small amount, you're not so concerned about losing part of that trade, right? So for example, let's say you have, sorry, I'm plugging in the charger for my laptop, but let's say you have a Microsoft calls for 3 weeks out, and the cons are, let's just say $4, so that's $400. And let's say you have a $5,000 account. Well, you have two options. You could buy 2 contracts, put $800, which is over 20%, I think, if not 30% of your account. And no, it's probably 20%. And the next day, even though you have 3 weeks out, you're very, not scared, but anxious about your position. Yeah, it could end up working out. You could trim that one extra contract at 20-30% and you can let it go, let the runner go, see where it goes. That's absolutely fine. But what about the other scenario where, let's say, instead of buying 2 contracts, you just bought 1, you're only risking $500, which is less than, I believe, 10%. Yeah. And when you do that, you allow your trade to develop, and then it's not so much emotion, right? One of the things I used to do, and I still do to this day, is I don't have my P&L up ever. What I have is percentage. That I need to know. But I don't have any of my money P&L thing that I can ever see on my account. I turned that off. I use Thinkorswim. I removed that column from my monitoring tab. So all my trades, I don't see the P&L. And the reason why I did that is because when I did that, even though I'm already monotone and not full of emotion, that helped me even more. So I didn't have like, I'm down $14,000. Oh, I'm down $1,400. I'm down $140. No, I don't think that, because I don't see it. All I see is percentages. And of course, if I see 30% down, yeah, in the back of my head, I might think, since I sized this much, I could kind of guess how much I'm down. But when that number is not in front of you, for me, it's helped me become a lot better in being able to keep emotion out of my trades. I know your question was how to develop a better trading mentality. The first thing is you got to get rid of your ego. If you have ego in trading, you're just dumb. I know I keep on saying that I have ego. That's just because I like saying that I like being right, and I do like being right. But I don't just like being right because I want to be right. I like being right because I planned for something, I researched about something, I put time into it, and I came up with a sentiment, right, or a target or a level. And I want it to work right, but that's I'm not risking my trade for that. You know what I mean? I'm not risking my position to reach that point. So trading mentality is something that exists and doesn't exist. It's just fetch to get a lot of YouTube thumbnails out there and YouTube videos and courses that you sell and buy. The reality is, it's just a lot of things are patience, and it has to do a lot with sizing. I mean, you could try it yourself, and you could see if, let's say, you're usually putting $1,000 into a position, but instead, let's say tomorrow you want to try putting only 200 or 300. Watch the amount of difference it makes for you to actually follow the initial plan you had. And again, the first step is to always have a plan on what you want your trades to be. So if you already have a plan, you size smaller, maybe test it out, right? Maybe you could see, hey, if I size smaller than what I usually do, can I let my trade run? Can I not have to worry so much? And when you do that, you'll start, instead of worrying so much about what's going on, you'll actually be able to see what's going on. And when you see what's going on, you'll be observing. And I told you one of the greatest reasons why I succeeded when it came to trading is because I was observing and I wasn't just stressing. And there's a huge difference, because you could just be looking at the chart to manage your position, and you could also be, or versus looking at the chart and actually observing what's happening. Let's say your trades are working against you. If you're, of course, sized in a very heavy position, you're not going to be really figuring out, oh, why did it not work out? More likely or not, you're just going to be sweating, and your balls are going to be sweaty because you're trying to figure out, oh, oh God, I hope it holds here. I hope it holds here. Or I hope it rejects here, right? And you're not actually seeing what's going on in front of you. You're not seeing, hey, maybe did I take this entry too early? Did I take this entry too late? Was I chasing? Even if I got into a good setup, what's happening here? Why is it not working out? And, if you answer these questions, you can only answer these questions by observing. So that's kind of like the long answer. And Thursday, I'll be hitting a lot of points that I think people either think about or don't think too much about. So more to that answer on Thursday. But when it comes to books, a lot of people think that you need to read trading books to get knowledge about anything that has to do with trading. The funny thing is, you actually don't have to. I talked about this a few months ago, and I told that one of my favorite books that actually does not relate to trading, but actually does relate to trading, if you relate to trading, is the book called The Book of Five Rings. It was written like centuries ago by this Japanese samurai, and all that book talks about is hard work, practice, and effort. And you might think that's cliche, and it's not, because it's not like, oh, the one of those feel good books. It's a book that talks about how things don't come easy, and it's a really great book. You should search it up. It's on Amazon. It's very cheap. Book of Five Rings. You could even get it from Barnes and Nobles, I think, for less than $10. It's a great book. But yeah. So the next question is, what qualify for your entry targets? I'm going to answer very quickly, and then JP can answer. But for me, my entry targets are based off of sector rotation and price. So what I mean by that is, take today for example. We saw stocks like Nvidia tumbling down. So that means if Nvidia is tumbling down, majority of the tech sector is going to be red as well, which we could see here, right? This is all the tech sector. You can see how red it was today. So what that usually means is that money is rotating out of that sector into another sector. So my job then is to figure out where the heck is the money going to, because usually whenever money is rotating to another sector, the sector that's having the money rotated into is the sector that usually ends up having a decent move to the upside. I've stated multiple times I like trading calls more than puts. I know I've been taking puts here and there, but I don't like to. Not because I can't trade puts, but because historically calls are always going to be the longer lasting trade. And as I said before, my trading style is where I like leaving runners. So I want to be in setups where I can leave a runner for a long time. Put setups that make sense are like, for example, last Monday we had the AMD puts. Those are over up like 600% or 500%, I forgot. So that makes sense. But I like getting into calls. So an easy way to do that is, whenever you have a red day like this, the first thing you want to do, or the first thing I do, let me correct about that. The first thing I do is I go onto TradingView, I open up a new tab, and I didn't see this. They added a calendar thing. I would usually press on heat maps, and then I'll press on stocks. When I'm on here, is default set to the S&P 500. You could keep it on here. That's absolutely up to you. I personally like viewing everything, so I click on the top left over here where it says S&P 500, and I click on all US companies. And what this does is it shows a heat map of everything that's that's tradable on the US stock market. And you can see here, obviously today, tech was pretty red, retail trade was red, finance was very red as well, manufacturing, consumer durables. But what were the sectors that were really strong. Well, on last Monday when we talked about the bearish market, that was one of the most perfectly timed videos and live sessions we could ever have, because all the sectors I said would be decently strong during a bear market are the ones that are hitting the green right now. So that's communications. I talked about communications being very important. JP and I talked about utilities. I heavily talked about consumer staples. So that's consumer non-durables, right? It's PG, KO, Pepsi, as JP was talking about. Philip Morris, the MO stock, I think is like, I keep on forgetting, Marlboro, whatever. I keep on forgetting its name. Health sector as well, even though health sector kind of got hit a little bit, it still did really well. Hence why I got the MRK calls. And then once you see like this heat map over here and you think, okay, you know, these sectors are green, you don't just go right ahead and buy those calls, right? Let's say, for example, you know, I like to see that the consumer non-durables section is pretty green. So what I'll do is I'll go onto my chart and I'll search up those tickers. So for example, Pepsi, look at, whoops, not Pepe. Look at Pepsi, and I've always talked about how my favorite call setups are ones that have curves behind it, or curls behind it. So I usually always look at the 30-minute first. I take a look at this. I'm like, okay, all right, there's a curl over here, which usually means that there was ample amount of time for buyers to, get into the setup. So the chances of this continuing to the upside is decently high. So then what I'll do is I'll make sure it fits my other criteria. I want to make sure it's not too overbought, right? I don't want to make sure I'm buying at just a high price point. So these are different things I usually do for entry. But the first thing is to always figure out where the sentiment is and where the sentiment is strong. And usually the easiest way to figure that out is finding where the money is rotating into. And you can do that by either scrolling into through your watch list on a red day and seeing what's green, or you could go to the stock heat map and look through there. JP, did you want to talk about what you usually look for entries, or? I guess JP's not here. All right. So he's going to be back in just a second. All right. Well, how do you set levels? How do you know when to start trimming? Well, okay, levels is pretty easy. In fact, we have a video on this. Levels is super simple. There's so many ways you could do this, many ways. I'm gonna go over a bunch of ways, and you guys can figure out which way you like. Let's go on to, what's a stock? Let's go on to Microsoft. Jeez, I can't type today. So let me delete all of these things here. There's many ways you could do levels. Easiest way is doing, well, not the easiest way, the most obvious way is doing through a candlestick, but I want to show you different ways in case it is hard for to draw levels on a candle chart. Yes, this is recording. The easiest way is actually changing into a Heikin Ashi. The reason why the Heikin Ashi is pretty simple, and I'll change the default colors over here. Apply defaults. All right. So the reason why I say Heikin Ashi is because you can easily tell when the trend changes. So when you could see a change in trend, like let's say on the top over here, that's just an easy place you could put a level, right? And then you could just, what you can do is you can find the reversal points, and you could set the levels to where those reversal points are. And when you do this, it's not like you just go, that's it, you just go according to this. You want to draw out your levels. You just draw out all the easy ones you could spot. And then once you're done doing that, you need to make sure, what I like to do is I want to make sure I don't have too many levels on my chart, because sometimes that just leads into clutter and hesitation for my trades. And realistically, people don't realize this. Just because you have more levels does not make you a better trader. If you have more levels, sometimes when you're in a trade, that level that might not be important that the price goes up to will cause you to exit your trade early when you could have potentially held that trade longer. So how do we remove the clutter levels, or levels that are not that important on our chart? Well, I'm going to go according to the daily here, but everything I say on here, on this part, can theoretically be applied to any time frame. So the easiest thing to do is throughout all the levels you have here, you want to find the levels that, even though they may have held up a few points, majority of the times they were easy to break past. So what do I mean by that? Well, first of all, this looks so cloudy. I mean, so freaking, 1 second. There we go. Looks cleaner. All right. So what do I mean by that? Well, okay, so 366.43 on the bottom here. That's fine. You know, it bounced off of that. It went up. All right, so what about this level 388.32? Well, yes, it did break over here, but you could see multiple times the price came down to this level and it's bounced. And even today, well, Friday it bounced off of that level and today it kind of wicked off that level. So you know what? We'll keep that level on there. But what about this level here at 401.91? Well, let's kind of just eyeball it over here. We kind of had a breakthrough over here, kind of had it here, bounced off of here, broke through this, bounced off of here, broke through this. So what's my natural thing here? Me personally, I'm going to remove it. Because yes, it's bounced off a few times, but I just feel like it's clutter on my chart. So then let's go up here to the 410.49. We can see actually that this level is kind of midway. You could say this is actually worse than the level before. So what we could do is we'll keep the level we had on before and we'll delete this one. Because at least this one had a few strong bounces after it, right? So there's a lot of thinking you have to do here. The levels are not just like, oh, brain dead thing. No, you got to figure out and you got to look back and you got to see if these levels are valuable or not. Because if you just have clutter, usually you just get very bad trades. Now let's see, 429.47. Is this something important to keep on our screen? Well, we could see it was a pretty important resistance 2 times over here, kind of broke past here. Maybe instead of having this level, maybe what we could do is we could keep this, but we'll get rid of this level. So see what I'm trying to say is it's easy to look past this. And even day trading, right? Let's say you're on the 5-minute. It's very simple to find levels as well. Easiest way is to just find prior ranges. Prior ranges are usually where price either runs up to or retraces back down to. So what I mean by that is, for example, this level over here, right? Because this is between a range. If you're day trading, this is an important level for you to look at, right? Because for the possibility that Microsoft were to come down, this is going to be an area which is going to catch a lot of attention. In fact, you could see here, according to a volume profile, which you guys, if you don't know that, you can check out our YouTube video on it. It shows that the volume starts peaking up at this point over here. So instead of having the levels so high up, you could put it down closer to where the volume shelf is. So why am I reducing as many levels as I have on my screen? Well, this ties into what we talked about last Monday. In a bear market, you're not going to have as many opportunities to be high frequency traders as you do in a bull market. So what that means is your levels are going to be very important because you want to be in trades that are actually valuable and have high quality. If they're not high quality, you're going to find yourself burnt. And the truth is, and I'm really sorry to say this, but I'm not going to sugarcoat it. A lot of you guys here are not going to be here from a year from now if you're not going to figure out what you're doing wrong and what you're doing right. Because you guys are going to end up quitting if you don't realistically realize what could possibly be heading your way. Apparently, I didn't know this, but apparently today, according to Twitter, and you guys could correct me if I'm wrong, apparently a lot of people are losing money today trading. I don't get how. I mean, there shouldn't be a reason why today, out of all days, should have been a very red day for some traders.
I can tell you why.
I mean, I know why, because everyone keeps on trying to buy the reversals, and that ties into what we talked about last week. You know, we're not getting out of a bear market. It's just not happening for the next months or even, a year, and if not 2 years. And you have to forget about the fact that you hope that the bounce is coming or anything like that. Yes, we will have some dead cat bounces. Yes, we'll maybe have some melt up phases. But just because of something you saw before, that does not mean it's going to repeat again, especially in the short term. You look at any major tech company, there is barely any bullish setups left. Everything is exhausted at this point. So trade what's on the chart, and this ties into the first question I answered. You have to have a plan. And I personally, I will never look at P&L. I think that's just not the right thing to do. I think you can avoid looking at P&L if you size correctly. But even if you do or if you don't, you just have to have a plan. Because if you have a plan, then all of these things are going to be pretty easy to get by. But yeah, that's a simple way to do levels, right? Heiken Ashi, just go use the Heiken Ashi 30-minute, there you go. You find the Heiken Ashi. You could just find the reversal points. You can do the same thing with Renko. I've talked about Renko before. It's actually a very, very strong tool you can use. I personally love it. Actually, I think I have I have a video that literally talks about using Renko charts to draw levels. But when it comes to candles, I mean, it's pretty straightforward. I'll just go on to another ticker. Let's just go on to Tesla, for example. So Tesla, how do we draw? Sorry. How do we draw levels on Tesla? Well, first you want to find the prior ranges. That would be right over here, right? Whoops, right over here, because that's prior range. And you want to find the bottom of that range, which is around 169. And then from there, you just find every single place where there was a major reversal point. That's what I like doing. And then, as I said, you would just go back on those levels and you would kind of see, okay, which levels actually held pretty well and which levels did not. So that's a very simple way. Again, we have a video on that, so I'm not going to go too deep into that. How do you know when to start trimming? I'll kind of answer that tomorrow, but simple answer is fib extensions is an easy one. We have a video on fib extensions. Trading in a bearish market can be troubling. How do you build the discipline to close the charts and walk away for the day?
In what capacity, though? Because if you're losing money on a bearish market, that means that you're trying to catch a reversal and you're not following the trend.
No, he's saying like not like over trading. Like you just, for example, like you're itching to get into a trade. Things like past your entry.
You shouldn't be itching to get into a trade. You should be setting your stop losses and your take profits. Whatever happens after your take profit, you don't care.
No, I know, JP. He's talking about like if you're not in a trade. He's talking about having the ability to get off the screens when there's nothing going on. You know what I mean?
Have a predefined plan.
Yeah, that's something, right? If things don't, as Randy said over there, like.
Randy's here. Hey, Randy.
If things don't have a plan, then if they're not just. Okay, here's a simple answer. I don't trade on Mondays. You think it's because I can't trade on Mondays or because I tell myself I shouldn't be trading 5 days a week? Obviously, it's the latter, right? If I wanted to, I could trade Mondays. I could trade every single hour. I could be massively green for the month. But what's the point of that? That's just like, there's no worth to it. I literally stopped day trading 4 months ago because I got bored of it. And I started to realize because I got bored of it, I started to not care about where my trades went. So I limited to the amount of risk that I would put myself onto, and I stopped day trading as much. So usually if you're trading with a group and that group's not helping you by making you feel like you're missing out, you just need to mute that, and that's just how it is, whether it's a Discord server or a group of friends or a group of guys. If you find people that are giving you the anxiety of feeling like you're missing out on what's going on and you don't want to trade that day for any reason, maybe you don't see a clear setup, maybe your head's not right, maybe you didn't get enough sleep, just mute it and walk away, and you're trying to say, how do you build a discipline? Well, why don't you do something like this? Why don't you pick a day where you don't trade? Simple as that. My thing was just not doing it on Monday. And if you think that's too much big of an ask, at least figure out, okay, what times do I want to be trading at? So let's say I know JP does this. For example, JP only trades from. Yeah, exactly. 9:30 to 11 or something like that, right? So,
Yeah, I don't take a trade after 11 o'clock. I refuse to.
yeah,
There's
and
no reason. There's absolutely no reason. I can't. There's no reason to do it.
JP's been holding up pretty well to that because, he trades the environments he knows that to trade. He trades the environments that have a high volume. And, after 11 o'clock, 11 all the way to 1, there's not really much going on. So he chooses
There's
to,
trades. Don't get me wrong. There's people that are taking trades and they're making 100% or doing this and that and yada yada. I just know my trading environment. I do well from 9:30 to 11. From 11 to 1:30, I don't do well. It's when I have a tendency to take my worst trades, and then I do very well from 3:15 to like 3:45. I always like to find my setups. I wait with Kevin sometimes to take my trades at the end of the day because we're looking at the same things. But if I see a setup, I'm already trying to get in it around 3:15, 3:30. But like I had a bad problem, which was over trading, especially in the most recent years, because we were on the screens, more than 8 hours a day because you get on at 6, you're looking at 7, you're looking at pre-market. It was insane. But you just have to disconnect from the screens. If you're looking at the screens the whole day, you're never gonna be able to see clear setups because your brain is so captivated in just staring at the chart that you eventually just start seeing things that aren't there. You need to give your eyes a rest. You need to give yourself a break. You're not going to catch every single trade. You're not going to catch every single move. You're not going to catch every single stock that's out there. And if you're trading with a community that's enticing you to do bad behavior, then you're in the wrong community.
also, it's, it's, it's not smart to realize that there's always going to be another trading day. And if you're trading like the world's going to end tomorrow, if the
You're going to
world's going
lose
to
your
end, what's
account.
the point of even trading in the first place? So there's always going to be
The
another
problem
trading
is that
day.
a lot of people, the problem is that for the past 3 years, everyone's traded a bull market. Especially, I mean, I don't think that, I don't know what's the average trading time of the people that are in this room. I mean, if there's anyone that's been trading since the early 2000s or even, since later, 2010 or better yet, pre 215. I mean, mostly everybody just learned how to trade bull setups. You know what I mean? All they do is know how to go long. Every time that there's a falling wedge, they go long. Every time there's an H pattern, they try to catch along. Everything is reversal, reversal, reversal. They don't know continuation patterns. And whenever every time there's a pullback, it's just buy the dip, buy the dip, buy the dip. And that's why people lose their accounts because they don't understand that when there's a market sell off or there's a sector rotation out of high beta or low beta, um, it's really happening. You know what I mean? It's like we even talked about this the other day. We were talking about the VIX. I literally gave the VIX levels to a T about what was going to happen. Why would you be long here? Why would you be long there? And it is what it is, man. We are in a bear market rally. We're in a bear market that will have some bullish rallies here and there. But today was a perfect example. If you look at Nvidia, everybody tried to catch that 113, 114 bounce on Nvidia. And I kept telling you, they're buying these 130 calls for no reason. No reason. And what would happen? It would pop like $1 and then they smack it right back down and then the premiums would get killed. So if this is not your trading environment, don't trade it. You don't have to trade. Wait until finally the bear market stops and you find bullish setups. Or like we always say, Kevin, right? Like if you don't know how to trade a bear market, look for bullish setups that cater to a bear market.
Yep. Calls are the easiest things to trade. That's why I keep on trying to trade calls, and
Yeah, but you can trade VIX. You can go the VIX long. Is Brandon in here? Is Brandon still here?
JP, we'll move on to another
Yeah, no,
question.
I was just saying our buddy Brandon, he went long VIX, made 30%.
Oh,
He didn't short the market. Well, he
okay.
shorted the market by going long.
Oh, who doesn't like calls, right? It's pretty nice. Congrats, Brandon, if you're on here. All right, next question. So, if you have a smaller options port, would it be best to set out till these stocks find bottoms, or is low beta good for small ports? I'm getting cooked catching bottoms. Well, before I even say anything, little disclaimer that we always have in our announcements. JP nor I are financial advisors. Everything we just talk about is based off of our personal opinions or prior experiences or other people's experiences. So always take that with a grain of salt. And your financial situation will always be different than ours. So I'm gonna answer this as a hypothetical, and I'm gonna answer it like as if I'm in that kind of situation. So let's say if I had a smaller portfolio, and this again, I'm not gonna go too deep into this because it's gonna tie into what we talk about on Thursday. Excuse me. The funny thing is, and I'm really glad you asked your question the way you asked it, because you kind of answered it, is if you're trying to find the bottom on stocks during the bear market in a small portfolio, that means you're looking at the wrong ones. That means you're looking at high beta. And the funny thing is, high beta stocks are always going to have, majority of times, more expensive contracts than the lower beta, right? You could go and check Coca-Cola, Pepsi, Kroger's, ABT, Merck, GIS, General Motors, even though General Motors is that, what'd you say? Yeah. Yeah, actually I take back on General Motors, but if you look at all these stocks, Verizon, right? Verizon's a great one. Verizon, AT&T, T-Mobile, which is TMUS. If you look at all of these stocks, you realize one thing: all of these are low beta, and sometimes these are the greatest option chains to trade for a small account. We actually talked about 3 weeks ago or 4 weeks ago, we talked about debit spreads, and I kept on saying about how debit spreads are some of the greatest small account strategies you can use. I have been personally doing by myself a small account challenge where I started from $400, and it's up at to like I think 800 was the peak. It's at 760 something. All of the trades I took on that were purely debit spreads, and it's very manageable to do it because they require less of your capital. So maybe one thing you might want to consider is debit spreads. We have a video on that, so you could check that out. And if you don't have a margin, or if you don't want to get a margin account, or if you don't want to do debit spreads, then in a bear market or even in a bull market, lower beta stocks are always going to be, in my experience, a great option chain to trade because their contracts are cheaper and they move less volatile. So there's a little bit safety on your end. Yeah. JP, by the way, if you have anything to say between any of my answers, you can feel free to interrupt me. The next question was, do you use MACD? JP does. He made a great presentation one day on the MACD. So we actually have a video on that on our YouTube. So definitely don't want to spend time talking about that. You could definitely watch that on our YouTube. Yeah, thanks, Silent Trees. UFC just signed a contract with Budweiser. Would you look at that, JP?
Mm-hmm.
Yeah. Yeah, Walmart is not a safe haven, unfortunately, right? I wish it was, but it's just not. How not to blow a funded account? Well,
That's hard.
high frequency trading just has to be off your list. Now, even that's not going to be a concrete answer, and it's not going to turn your progress 180. But majority of the times, why do you think prop firms always win? It's because I actually have a perfect video on this. I literally talk about why prop firms are bad. And it was very eye-opening for a lot of people. And even JP talked about in the past why he doesn't like it. You should check that out. I'll link it, I guess. But look, the thing is, it's so easy to fund these prop accounts, but it's harder to keep it because when you get a funded account, everyone's always in a rush to get that money out, or they start getting hesitant. And rushing and hesitation is the two things that always kill you when you when you trade in general. And obviously, when you mix that in with high frequency or oversizing, that's when you start finding yourself in a deep hole where your funded account is now just down or just liquidated. So I'm going to link this video that I had, which I made 7 months ago. I posted it in the main chat. You guys could check that out. In that video, yes, I do talk badly about prop firms. That's just the truth. But I do talk about how you could potentially grow one if you were to trade it reasonably. So you could check that out. What volume indicators on the right side of my chart? Yeah, that's volume profile. Again, we have a video on that. JP, this is a question you can answer. Are levels useful for SPX since it's a bunch of stocks in
Absolutely.
one?
The S&P levels are a critical part of my trading. It's S&P respects levels. They respect everything is just like anything would. Just because it's an ETF, well, not an ETF, just because it's an index doesn't mean that it's not gonna price will not gravitate back to key areas of support and resistance. So yeah, levels are very important, especially in the S&P, on all indexes.
Cool. Because of last week was such a bearish week that everyone thought it was going to be a bull run today. Yeah, that's
I don't know why.
because that's kind of been what's happening, past 2 months, right? Whenever we had like really significant red days, everyone would buy puts near close because everything looks bearish, and then the next day it would just kind of pop up. So again, it kind of leads into what JP was saying earlier and what I talked about on Monday, which is everyone's just so used to buying the run-ups that they think it's gonna keep continuing. Well, sometimes you might get lucky, but the times you don't, you could find yourself in a bigger hole than what you expected.
Do me a favor. Can you pull up the Nvidia chart?
Yep.
All right. Can you see that can you go to the 30-minute? Look at how many times today everyone tried to play that a bounce. They tried to play the bounce off that trend line, then they tried to play the 414, the 114. Then they all tried to play the breakout at 112. They thought a double bottom there. Like, you can see where retail buying is happening. You can just see it. It's clear as day. Everyone's just trying to catch a bottom, and then they just get smoked. It's really sad to see it because we were talking about it when you and I were trading. It's like it was trading. It was trading
Oh,
up to it, get smoked. Whacked and just come right back down. But yeah, I mean, people eventually people. I think people eventually learn that just because there's a red day doesn't mean that tomorrow's going to be a green day. That continuation patterns do exist, and it's all based on volume, right? So today on the daily, look at the amount of volume that was on the sell side. You know, you're going to need twice as much volume on the buy side to recover that candle. How much was sold off on Nvidia today? How much volume was there? If you just hover above it
well, today it was 410 million.
in volume today.
Yeah.
You think we're gonna have 410 million tomorrow on the buy side? You know,
Well, I know you know the difference, but I just want to clarify. When JP says buy side and sell side, there's not actually buying volume and selling volume. It's just more volume on bearish candles versus more volume on bullish candles. So what JP is saying is, since we had such a strong bearish day and we have a huge amount of volume, 410 million, let's consider it's bearish volume. So yeah.
you're gonna need twice as much of that volume on tomorrow. I mean, no, you don't need twice as much, but I mean, think about it. If you had 410 million today on Nvidia sold off, right? You think you're gonna have 410 million tomorrow to flip it green? I mean, come on, man. When it does start to go up, it's going to be a slow grind back to the upside. That's the other thing people don't realize. Flush outs are heavier than the upticks, right? People don't get that because when there's exit to liquidity, it's massive as opposed to the buy side. So
Yeah, that's very true. All right. Someone asked, why did I enter into SoFi into my long term? if this is a very good question. So why do you enter SoFi in the long term? It's a tech too, right? Absolutely, it is absolutely high beta. But I also like growth on my long term. So what I mean by that is, on my long term, I'm starting to get into a lot of lower beta stocks. So I'm getting into, I think I got into GIS today. I got into BTI today. I got into Oscar today. I got more Oscar today. So the reason why I got SoFi, for example, is, well, I'm bullish on SoFi in the long term. So I'm just building myself a very small position in SoFi that I would not mind holding and just forgetting about. So I only bought 650 shares of that small account challenge I was doing, the 240K, which is just 3.9% of the portfolio. So it's not realistically a big position. It's just like it's just a small starter position here, and just kind of seeing, what really happens. Realistically, I would not mind if SoFi comes all the way down to $10. I would not mind adding there. Even if it comes down to $7, which I don't think it will, but let's just say it did, I don't mind adding there too, because realistically, the thing is, if you're in a long-term account, there's different ways to grow it. And if you're trying to just actually build a position into a company you believe will be pretty strong in the future, it's not always a bad thing to potentially start having, starter positions, right? Because you can't always perfectly time everything on a consistent basis. So that's why I got it, because it hit the criteria, which was it held the 38 fib, the 38 ratio on the bullish fib. So that was a buy signal for me. But I sized accordingly, where if it comes down, I do not mind, because it's a long-term play. So hopefully that answers your question. With Wix, Joe Bosco, you would have to clarify your question there. When charting, how does pre-market levels and previous debt levels play into this? Well, when it comes to stocks, I've always been vocal about how I personally think they're not useful. I think they're just extra noise. And usually, a lot of times, whenever you get usually a pre-market level is a level that's already on a bigger time frame that just gets respected in the pre-market. So it's not like as if that pre-market level holds any significant value, if you get what I'm trying to say. So I kind of answered your first part, which is I don't look at pre-market levels. I never thought they're important. But let's say you're day trading, the previous day levels are very important, especially the previous day. Sorry, I'm burping a lot because I just broke my fast not that long ago. The previous day lows and the previous day highs are very important. So what I mean by this, let's say the market, as you guys can see my screen, I'm on Meta. I'm on the 5-minute chart. Let's say the market is still open and Meta is all the way down here, right? Let's say for some reason I like calls, maybe because it bounced off an important daily level, whatever the reason is. Well, I want to look at the previous day and I want to find, okay, where are the previous day lows? Especially if the current price is below those previous day lows, that means those previous day lows are now resistance. So if the price gets above those that resistance, then that's a pretty strong. That gives me a pretty good indication that the calls have a higher chance of running. So that's why it's important to look at I think it's important to look at the previous day lows, previous day highs, kind of figure out where those are, right? And you'll see like the previous day highs and lows kind of got respected here. Like for example, Meta's Friday high over here got respected today on this bear flag, right? We had a bear flag into this level, which kind of topped out over here, rejected that, couldn't get back above it, and it ended up coming down. Trade over here would have been like 40 to 60% just because of how high the IV is on the Meta contracts. So yeah, previous day levels, if you're day trading, I personally think are pretty important. But a lot of levels you can find previous day are also found on bigger time frames as well. Would you dollar cost average in this market? When or would you see to start a long-term position? For example, would you do it at key levels or major MA for the Mag 7? I'm so sorry. What do you mean by MA? If you can just answer what MA
I
means.
think it means moving average.
Oh. Oh, okay. Gotcha. Thank you, JP. So when it comes to long term, again, really depends on what your goal is. If it's a buy and forget, then I personally think it's just best to, hey, if you, for example, look at fibs and you want to add at the 68 ratio and it comes and hits the 68 ratio and it does what you want, if you're doing a buy and forget and you're investing in a strong company, even if we're in a bear market, theoretically, you expect the market to rebound, after a significant amount of time. So if it hits your criterias and it's down significantly from where it was, let's say a few months ago, then I personally think that's not a bad thing to do if you're in a long-term portfolio, which again, you're looking to buy and hold. But if you're trying to do like midterm investing, which is where you try to only hold it for a few weeks or a few months, that's where dollar cost averaging is going to be pretty hard to do. It's going to be pretty risky. One of the things is when it comes to long-term investing, you could always look at the 200 moving average, as it's considered as a pretty strong share indicator. So the theory is you would always like accumulating, quote unquote, shares of the underlying stock when it's below the 200 moving average and when it bounces off a level you like. But you have to also figure out, okay, is this a high beta stock where it could keep on moving down pretty hard? Or is this a low beta stock? So for example, NVIDIA, we could see it's below the 200 moving average. Just because it's below the 200 moving average, it doesn't mean I'm going to buy NVIDIA shares. Yeah, of course, maybe we could bounce and we could go to 150. Well, what's going to happen after that? It's probably going to crumble down and you're going to probably see levels below 100. So then what you want to do is you want to try to draw out your fib retracement, which again, we have a video on. I'm just drawing an example one right here. And maybe I want to start adding shares around $82 because then I'll have shares below the 200 moving average and I'll have it at a fib ratio. So then it makes a lot more sense. But if it's stocks such as, let's say, GIS, which is General Mills, which already gives a decent dividend of, I think, 4%. Yeah, 3.94%. Then the dollar cost averaging is not as risky because you're getting the dividends, which of course are not the biggest, but they're still something. And once the market rallies, the stock will also rally as well, which will give back the value that you lost. And also the dividends will be there to kind of offset any prior losses as well. So, yeah. It's more based on what your objectives are with long term. If it's buy and forget, then the answer is you just have to make sure you buy it at undervalued areas. And the best way to figure that out is usually the Fibonacci retracement and looking at the weekly chart. That's just very easy to do. You just find the swing low, swing high. You draw a fib retracement. You could see here, one of the reasons why I bought GIS today is because it bounced off of the 61 ratio on the weekly. So that is a buy signal for me. And it's also below the 200 moving average on the weekly as well. Right. Does that mean you're completely disconnected? I think you already answered. If you're talking about the charts on Monday, yeah, I tried to be away from the chart in total. Today I wasn't, but that's because I had to manage my swings.
We talk, but you're not looking at shit. You know what I mean?
Yeah, exactly. Thank you.
You're disconnected, but not disconnected, if that makes any sense.
Yeah, it's easy. You could look at the charts, but it's a different thing between looking at the charts and having your trading account open. But if you're having your charts open, that's gonna, kind of push you to trade. Then okay, you have to just maybe say okay, all right, maybe I need to close everything. Yeah, I'm 18. My first year trading gonna be very different. I feel I see people trying to short the VIX right now. Yeah, I mean, since you're young, that's pretty great.
The VIX right now. Who did you see trying to short the VIX?
Bro, there's multiple people out there.
No, that's not possible. I don't believe that.
What do you mean you don't believe that?
You saw people trying to short the VIX today?
Yeah, with puts probably.
No way.
Yes, people are dumb. And even if it works out tomorrow, maybe it's just an overnight swing. Who knows? Um,
Wow. Have fun.
I doubled a
Whoever
400
shorted the big.
400 $400 account in a month. Yeah, it's pretty easy with debit spreads. I talked about it exactly. One of the biggest reasons was because of the IBM trade. How long do you think it would take for someone to gain access to level 3 option trading? That I don't know how the answer to. Each trading platform has a different requirement for reaching different option levels. It's more based on trading experience, risk tolerance, and
There's an application process.
yeah, net liquidity or something. I forgot what it's called. So
I wanted to interject here and just say something on prop firms from a personal experience, if you guys don't mind.
yeah, what's up, Randy?
Yeah. So I stopped. I'll tell you guys this. Like I
Wait,
started my
one second, Randy. If you guys don't know who Randy is, it's my fault. He's a trading buddy of ours. He's a big he's he knows a lot about stuff when it comes to the economics and quant trading and stuff like that. So yeah, but go ahead.
He's also very good looking. Yeah, right.
Thank you. I'll say this to you guys. So I'm personally new to trading. I started back in hardcore serious day trading, swing trading. So back in 2023 is when I met Kevin and JP. Um, so over the last, so I started on prop firms, as you guys know, and I stopped trading prop back in July of 2024, and kind of just realized that I was always on a hamster wheel, like Kevin was saying. I was constantly blowing accounts. Risk management wasn't really there, um, and I would just personally say that after I stopped trading on prop, I was much more careful with my trades, much more responsible, and that's only because you know it's my stuff, it's my money, so I have to be careful with it. So it's not, and I have to be responsible. So that's just my personal take on it. Rather than prop, a lot of people like their mentality. What I realize is that it's just like, oh, I'll just who cares if I blow this account? I got another 15 or prop accounts or something like that. Well, if you have that kind of mentality, you're not going to really make it, because imagine if that was real money. And a lot of people with these prop accounts don't see the value of real money. $1 is still $1, $20 is still $20. So just keep that in mind. But my trading got a whole lot better, and I just felt like it's pretty much, I just felt it was my rules, my money. So I didn't have to ask somebody permission to, withdraw. I could, if I wanted to take it to my bank account, I can take it to my bank account. Again, it's not yours until it's in your bank account. So
Mhm.
um, that's all I had to say, guys.
It
Thanks for letting me
also
speak on
it
that.
also entices prop firms entice you to trade bigger size that you normally would never trade because you have to have certain margin requirements when you trade futures with your own cash. If you're trading ES overnight swings, you need $1,500 per contract that you're swinging. Or I'm sorry, Randy, I always forget what it is. It's 1,500 for me for micros
Yes,
for
correct.
swinging. It's 500 for intraday trading. So now grab that and multiply that with the necessary numerator for the minis. People don't value making $100. People don't value making $50. So when you take an actual MES contract or an MNQ, a micro, but let's say you take two micro Nasdaqs, which is at that point, that's $20 every 10 points, right? I believe so. If it's five is 100 because a full one is
Yes.
200. So half of that is 50. So it's like $45 every 10 points. You suddenly start to value the money that you're making because you could easily lose 200-300 bucks on a mini on a micro. In prop, you're like, oh, I'm only down $600. Well, if you're down $600 in real life, it sucks. So that's why Kevin and I are most of the people that we trade with. We're not advocates for trading prop. It's we some of us like me. I sometimes will fall in the habit of buying an account because it's just very tempting, and I'm not perfect, and nor will I ever be perfect. But it's like sometimes like I don't want to trade my own money. I'm just gonna go buy a prop account, and then you go through the whole process of making $3,000 and you fund it, and then you pay the $149. So you just spend $200 to get a funded account, and then you're trading it because you're scared. Because oh my god, I have to make $200 a day to get a payout, and then you put all that pressure on yourself, and you're never truly trading free. And the idea of trading is to trade free without any responsibility of having to worry about someone setting rules on you except for yourself. Prop creates rules for you, which create limitations, which create the feeling and the need to want to do something, right? Like, I have to accomplish this so I can get paid. That's how they make money because they get in your head. So, yeah.
Yeah, I appreciate you guys answering that. Um, last thing I'll say about prop firms is obviously there's different ones out there. Some are expensive, some are cheap. For example, Apex is sometimes accounts between $80 to $150, versus CFD accounts are, $300 to $1,000. And me personally, and again, I think you guys should really watch that video I put on the main chat, which is why I think prop firms are bad. One of my main points is, instead of just, putting time into an account, which majority of you guys, again, I'm sorry if this is blunt, but it's truth, majority of you guys will blow after it's funded. I just don't see how it's better just buying a prop firm over and over again, instead of just putting whatever money I would have spent on a prop firm account into an options account. And I just give myself more capital to work with, where I can actually, withdraw cash or put in cash based on when I actually need it, right? So it's a lot less restrictions, like JP and Randy were talking about, and so on and so forth. But yeah, all right, let's see what else. I see a lot of people trade off data and order flow. If you ever heard of quant data, what's your opinion on that? Well, order flow, what exactly you mean? You mean in terms of level 2s, level 3s, and option flow? Is that what you're talking about? Or what exactly? I know of quant data. Oh, delta, gamma. Yeah, I mean, okay, if you learn gamma exposure, delta, and gamma squeezes, stuff like that, they're very important to learn, and we will have a live session on that. I've consistently used it for trading. All successful people who are swing traders use it consistently for swinging. It's a very complex subject that can't be taught in a matter of minutes or even an hour. That's going to be something we would have to go over. There's many multiple ways you can try to figure it out. You can figure it out through option flow platforms such as Unusual Whales. We're not sponsored by them. Or what's it called? Or even looking at the option chain sometimes can give you a theory of what's going on and what you're looking at. So yeah, it's pretty decent. But the thing is, here's the thing. With anything that has to do with order flow, option flow, or level 2s or gamma, you can easily be tricked into thinking something or seeing something, and then it turns out to be false. So you have to really be smart and know what you're looking at, because you can easily get faked out. So that's why when we have the live session on that, it will be a pretty lengthy one, because we had to distinguish about what is actually valid and what's not actually valid.
Level 2 trading is one of the hardest things to do. I only trade level 2. I trade level 2 trading and time and sales, and that's basically order flow. And I only have charts up because I need them, but I could take trades strictly off level 2 and time and sales. But it becomes very, very, very psychotic and very, very chaotic, because there's a lot of hidden orders, there's a lot of fake orders, there's a lot of blocks, and you don't know what's what, which is why you have to have levels, and you have to have it on your charts, because the block orders on the level 2s will coincide with the levels on your chart, most of the time daily levels. So like, for example, if you're trading Apple, everybody knows that there's a technical block at 234. I mean, can you open up Apple?
What?
Can you open up Apple? Can you draw a level at 234. And you go to the daily or something. See if that's lining up. It's right there. Yeah, there's huge block orders at 234 on the level 2s on the order book. Yeah, and it's you see it right there. There's a level at 234. There's also a huge order stacked at I think it's 218 or 217. There's like 90,000 units waiting down there, right? And I'm sure that 217, 218 level lines up with a daily level. Is that a daily level on Apple?
Somewhat, yeah.
So you can see that on the book. But when you start reading book and you start reading tape, oh my God, it's very, very lengthy and very complicated. And some people find it very annoying when Kevin and I are trading. I'll tell Kevin will be like, "Hey, dude, I really like this at this level," and I'm like, "What's the level?" And I said, "Okay, well, we got to get above like whatever 7283." He's like, "Where'd you get that 83 from?" So there's a big block there. It's like, "Oh yeah, okay, I see the block on the level here on the candle," because he doesn't need to level 2s because he reads candlestick patterns, so he can get the same stuff that I see on level 2. Kevin reads off candles, so it's one or the other. But I like looking at the level 2, kind of for two reasons. Number one, I like seeing the amount of flow that's coming in other words, the limit orders and the market orders. And I know this is going to sound really stupid, but it's kind of cool. and I like knowing how to read it. So that's it.
Funny. All right. Yeah, let's see the next question. I remember you mentioned credit spreads and Costco and possibly some other value companies. Do you have a day to expiration and delta that you typically look for? Well, the what's the saying? The basic rule when it comes to the credit spreads, if you want a mix of risk and safety, usually it's around 30 delta. But yeah, I think 30 delta is pretty great. But if you're doing 30 delta, then doing the same week expirations are going to be pretty risky because you have a higher chance of it going in the money, right? So usually my sweet spot is anywhere between 21 to 30 days of expiration. So I get credit spreads between those two DTEs, and I choose a delta around 30. And if it's the same week, if I'm really bullish or really bearish on a stock, and I get a put credit spread or call credit spread, then I look around for a delta for the weekly contracts. I look around a delta between 10 to 14, and I go according to that. That's just the quote unquote safer way to do it. Yeah. How do you decide when to use a put credit spread versus a call debit spread? Very simple. You go into the option chain and you figure out what the current IV percentile is. If the current IV percentile is above 50%, then you would want to have a put credit spread. If it's below 50%, you would want to have a call debit spread. The reason is because this ties into what we talked about on the live session where we talked about implied volatility and choosing contracts. Current IV percentile is a very, very important number to look at. I'm going to actually pull up my Thinkorswim. I just need to make sure it doesn't show my information on there. But we talked about current IV percentile, and I really hope people listen to that part because that is one of the biggest things that you can look at when you're swing trading especially, and day trading actually. So whenever you have the current IV percentile above 50%, let's say it's at 80%. If the current IV percentile of a stock is at 80%, what that means is the current IV on the contracts are higher than 80% of the days in the past year. So the past 52 trading days, 52 weeks, sorry. And if it's like, let's say a lower number and it's 20%, then the current IV percentile is 20%. That means the current IV that's on the contracts is only higher than 20% of the days in the past 52 weeks. So it's, I believe that's the way it works. So that's something really important. And obviously when you're in a put credit spread or any credit spread, you're selling options. And when you sell options, you want to be working with IV and theta. So the higher the IV, the more chances that when the trade goes your way, the opposite contracts, which in this sense, if you're, let's say you get a put credit spread on Hood, if Hood goes up, obviously since the contracts are so high IV, the puts will actually decay much quicker because the IV is so high. So that's why a put credit spread would make sense in that scenario. But for a stock, let's say like Best Buy, which current IV percentile was down below 20% for like 8 consecutive weeks, that's a stock you would want to get called debit spread for, because you're buying a contract in a low IV percentile, and if it really goes your way, the IV increases, which also inflates your contracts, which again works really in your favor. So that's why I'll pull up again over here. For example, I'm gonna bring it up on my screen right now, and I'm gonna go over just like 1 or 2 examples here. So let me just. All right, I have this account up. That's fine. Are you guys able to see my Thinkorswim? Someone can just reply yes. All right. So this is again going to be a very quick run through, because it's also, if you don't even trade credit spreads, it's very important to know this. And people charge you hundreds of dollars for this bull crap. Excuse my language. But this is Thinkorswim, but on Webull and almost other big trading platform that's worthwhile trading on, I don't know if Robinhood shows it, you will see somewhere where it talks about current IV percentile. Again, this is Coca-Cola. You could see the current IV percentile is 36%. To put it simply, that means the current IV on the contracts are only higher than 36% of the days in the last 52 weeks. So that's a year. There's 52 trading weeks in a year. So if it's 36%, that means the IV is pretty low, right? Compared to if it's 80%, that means the current IV at that time is 80% higher than 80% of the days in the last 52 weeks. So obviously
And
you
there's
do,
52 trading weeks in a year.
yeah, like, you know how there's always the 52 week high, 52 week low.
Oh, okay. Because
Yeah.
there's not 52 trading weeks in a year.
Yeah, my bad. So if the current IV percentile is high, that means few things. That means 1, the contracts you're trading are very volatile. 2, the contracts you're trading are very expensive. And 3, those contracts have a higher chance of going from being inflated to deflated. Because statistically, when you look at math, and trading involves a lot of math, and that's just the reality, there's always a thing called a mean reversion. That means things that are above and below the mean drastically are always going to revert back into the mean. So the mean is always going to be 50%. So if the current IV percentile is at 80, eventually it's going to go back down to 50. If the current IV percentile is 8, it's eventually going to go back to 50. So if the current IV percentiles are very high, maybe you have to realize it's riskier to trade those options. And tying back to your question, Betty, if the current IV percentile is above 50%, that would be an area where you'd want to sell contracts or sell options, because you're going to be profiting off of IV crushes. Versus if the current IV percentile is below 50%, that's when you would want to be buying options, because then once the IV increases, your contract prices increase as well, which in the case would benefit for the debit spreads. Again, if you guys don't know debits and credit spreads, you should really learn those, especially credit spreads. I cannot tell you enough. In a bear market, one of your greatest friends could be credit spreads if you do it right. Because there's going to be so many IV crushes. The IV is going to be high. Everything's going to be all over the place. And one of the things that will always be on your side when you're trading credit spreads is theta and IV crushes. So definitely look at our video for that. Just go onto our YouTube. If you guys don't know our YouTube, there's a links channel in our server for live sessions. Click on that and you'll see I have a link there that says our YouTube right here, right? So click on that, go watch that video. Let me bring up another example. So KO, you can see the current IV percentile is 36%. Let's go on to Tesla. You'll see that the current IV percentile is 88%. So here, would I want to be buying debit spreads or would I be wanting to sell credit spreads? The answer is selling credit spreads. Yes, of course, you could profit off of buying options and stuff like that, but you have to realize there's much more risk because of that. So 88%, pretty high. If we go on to, I'll give two more examples. Let's go on to NVIDIA. NVIDIA's current IV percentile is 58. 1 week ago, this current IV percentile was 76. So you could see how the mean reversion works over here, and it's reverting back to the mean, which is 50%. BBY, which is Best Buy, which was known to be a low current IV stock. This 3 weeks ago, I made a post about how Best Buy, if it sets up for calls, is going to be one of the greatest setups we could trade in a huge time. Guess what? That current IV percentile, those many weeks ago, was 8%. It is now currently 80% because of earnings. So you could see how the IV changes tremendously for option contracts, and it really matters even if you're day trading to know what kind of IV percentile you're trading in. Because let's say tomorrow comes and you're trading Tesla, you better know what the current IV percentile is, because if that trade works against you, you need to know, okay, do I need to cut out quickly? Am I going to be in a lot of pain, or can I let this run? And if you don't have that answer, it's because you're now looking at the current IV percentile to figure out, okay, all right, this is a very high IV environment, or this is a very low IV environment, and make a better trading plan according to that. So
I have a better thing for you to like. Why don't you define what IV is in simpler terms?
I don't need to. The simplest way to look at it is just, well, we said it more in our video. It's just basically the predicted volatility that stock will face, which is then brought onto the options. So if there's going to be more predicted volatility, or volatility means basically sudden and drastic price movements. So for example, you take Best Buy, which is having its earnings. Obviously, when a stock has its earnings, that means it's predicted to move very strongly in one way or the other, whether it's bullish or bearish. So because of that increased volatility, which again, volatility refers to the different price ranges and how drastically a price will change, the option contracts will increase in IV, which stands for implied volatility. The very simple way you could think about implied volatility, because I don't think it's very important personally to figure out exactly the perfect details of what the definition is you have to realize that implied volatility increases and decreases option prices. So when the predicted volatility of a stock is high, meaning if the stock is predicted to have a very sharp movement in either direction, the IV on the contracts increase, which means the prices of the contracts increase, because traders are now buying in these options. There's much more buying into the options, and because of that, of course, the prices of the contracts increase. You also have different Greeks that tie into this, but again, that just gets into a much more complicated area, which again, you don't necessarily have to look at for understanding what IV means. So IV again is if the stock is predicted to have a very sharp move or sudden move, especially sudden, emphasis on sudden, IVs are going to be higher. And when the IV is higher, the contracts are going to be much more expensive. So for example, if a $250 Tesla call, for example, usually is worth $2.50 at a current IV percentile of 50%, in a current IV percentile of 80%, that $2.50 call will actually be worth almost close to $6. So the drastic, huge inflation in price makes the contracts much more riskier, but also offer higher reward. Versus when the IV is lower, the contracts are much cheaper, which means that the stock was most likely in a range or consolidating for a decent amount of time. And if you buy a contract in a low IV environment or at a low implied volatility mark, if that stock starts moving in your way pretty significantly, you can actually benefit off of the IV increasing because since you bought the option, obviously you want the option to increase in value. So the IV increase inflates your contracts even more, additional to the stock moving in your way. And that's how you benefit off of IV. And it's the opposite. When you're selling options, you want the IV to be so high, and that when the stock moves your way, the contracts that you're selling, which again are, if you're selling puts, you want the stock to be bullish. So if the stock moves your way, then those contracts that you're selling lose significant amount of value because of the inflated price due to IV, that you benefit off of that. So that's basically how you look at IV. It's just you look at it as, hey, how much is the contract inflated or deflated? How much risk am I putting on? And does this mean that the stock is predicted to move predicted to move very suddenly and very sharply in a close amount of time? Hence why you see high in IV on contracts when there's economic data, when there's earnings especially, when there's earnings in that same sector that affect the stock. For example, when NVIDIA has earnings, what do you think are the stocks that have high IV along with it? TSM, AMD, MU, INTC. Those are some examples. So yeah, again,
you can think of it as the percentage that an options contract will move based on the price that the option.
JP, that's confusing.
That's it. That's it. It's how much the options are going to move based on how the price moves of the stock. High IV means it's going to move a lot. Low IV means it's going to move very little.
Yeah. All right. Let's see. When you look at IV percentile, do you look for 52 weeks IV or 13 weeks? I didn't know there was a difference. I thought default when it comes to the phrase current IV percentile, it only goes according to the 52 weeks. I would much rather the 52 weeks regardless. If you guys know me, I always like more data than less data. So 52 weeks is always going to be a preference. Because then that means the value that I'm looking at holds a lot more truer because it has a lot more data to go based off of. All right. Do you know where to check 52 weeks on E-Trade? JP, does E-Trade have current IV percentile?
Yeah, it does. I use E-Trade Pro. I wouldn't be able to tell you on E-Trade Power. If you have E-Trade Pro, I can show you, but I don't know on E-Trade Power. I don't touch E-Trade Power.
Usually, that kind of relevant data, even on Webull, for example, is always on the option. So if you go to the option chain, if you look really carefully around that screen, it should either show something related to IV and 52-week high, 52-week low, and also if you don't
on
see
the options on the options chain on the settings, you should be able to add a column that shows you the 52-week high and 52-week low of IV as well. There's like a setting inside there.
Yeah.
I don't use it. Do you?
Me?
Mm-hmm.
I mean, default, the TradingView brings up the 52-week high IV and 52-week low IV, but at the same time, you could get that information from the current IV percentile. So
I never look at it.
Yeah, I personally always look at current IV percentile.
Current, but not 52-week high or low.
Oh yeah. Let's see. Yeah, Thinkorswim is much better than Webull. All right. Do you guys have any other questions? Like, this is the opportunity to ask almost anything.
I know, right?
You guys literally message me for one-on-ones, paid one-on-ones, which again, I don't mind, but
hey, yo,
yeah, you have the opportunity to ask for free right now, you know?
Don't be shy. Yeah. I don't bite.
I'm about to, I broke my fast, so I haven't been eating all this. I'm gonna eat, again.
JP, where is the VIX trade? I am in my own VIX trade, Betty. You know that I'm very quiet about my VIX trades. A lot of people don't understand how to trade the VIX, so I don't really talk too much about it. You know that. Although my buddy Brandon, he took a really nice VIX trade. He took April 18, 22 calls. He was up like 35%. He took it off the levels that I gave him, I think. He literally took that technical bounce off the of the 1970 or something like that. He just rode it all the way to 22. I think he's still holding it.
So someone asked me about my opinion on XYZ.
Oh God, block? Is that still a thing?
Look, bro, don't let my sentiment divert you from any plan you might have, but I'm not a fan of XYZ anymore. Square used to have
They changed the name. It ruined everything.
dude, look, I don't blame you for buying. I'm gonna call it Square. I don't blame you for buying Square when you did, because this was actually one of the most bullish setups on the weekly before they changed their name and the whole crypto thing. Yeah, like if I go back to replay over here, if you guys actually recall, we were talking about XYZ 2 months ago, and this was
That's a perfect inverted head and shoulders on the daily. Come on.
like it looked great. Here it broke out of the range. It was testing the top of the range, seeing if it can hold that. But ever since, I don't know what it
Name
is,
change.
man. Like they changed the
Name change,
name,
man.
and this seems like it has leeway all the way down to yeah, it's already at 62, so probably 53. Me personally, if I have a lot of
Oh, I have something. I have even lower than that. I have 39.
yeah, I mean that's like drastic measures, but yeah, 39 is possible. I mean, it really there's few things you want to consider. If this is like if you have research and you're like, okay, I'm really confident in XYZ for some reason, if I'm confident in Square, then if I have over 100 shares, a possibility is selling calls, since that kind of reduces the amount of pain you're facing. But even after a certain amount of time, those selling calls, the covered calls, don't make as much sense. So
What was his entry?
90.
90. Oh God, you poor thing. I feel your pain. It's like my Uber trade where I thought it was gonna go to the moon 3 years ago and then it wrecked me.
Yeah.
Are you heavy in that? I mean, you don't have to. I'm not trying to.
I can't blame you for being in Square.
No, just 80 shares.
I definitely can't blame you. I was disappointed with Square as well. I don't know why they changed it.
If you look at that setup from December 30th, right shoulder head, I'm sorry, left shoulder, right head. Oh my God. Left shoulder, head, right shoulder. I thought it was going to break out and just go all the way to the moon, dude, at that point. I thought it was going to go nuts. But it just got blocked at 94. Was that right when the name changed? Kevin, are you there? You muted yourself.
Sorry, what did you ask?
Was that drop exactly when they changed their name? Because that was a perfect inverted head and shoulders on the daily.
Yeah, their name change came out, and then
What day was that? Do you remember?
No, I don't.
Because if it was January 30th, like it almost feels like it was on purpose. I swear to God. Because that's like a perfect setup for it to try to break that 98. I would have taken that trade.
By the way, since
I really do see 55 on this. By the way, I don't want to be a Debbie Downer, but 55 just feels like it's realistic.
I keep on getting asked what indicator that was. So if you go onto TradingView and you press indicators and you search up revenue, you'll see this indicator called total revenue, and you click on the quarterly, it'll actually bring up something like this, and this just shows the revenue that company has gotten every single quarter. So the reason why I personally like looking at it is just seeing if they're increasing their revenue as the time goes on. So it's just a nice little, instead of clicking each and everything or researching it myself, I could just kind of see here, okay, has the revenue been increasing? How consistently has it been? And so on. What IV do you look for? Well, I like getting into, again, I look at current IV percentile. I don't look at IV. So I usually always like getting into swing anything that has 60% or lower. That's okay for me. The lower it is, the better. That's my thing. So 60% current IV percentile or lower. This may sound like a stupid question, but in both your opinions and experience, how long do you think a bear market would last? Don't get me wrong, I know there's no exact number and you don't have a crystal ball to have an exact time frame, but just curious, how long do you guys assume? Well, for me, I think it's definitely going to last a year minimum, and I think the sweet spot might be at 2 years. Now,
It depends. It depends, Kevin.
yeah, like
Really
it really
depends.
depends on the speed, as probably JP's.
No, no. It depends on the economic factors that are creating the bear market. Is it inflationary? Is it stagnation? Is it deflationary? Is it
Would
cycle
you
period?
would you
You
be able to
know, it's all.
explain like stagflation, difference between that and the
I
other
mean,
one you said?
if there, I would expect people to know what inflation, stagflation, and deflation is, right?
People only know inflation, majority.
Okay, so stagflation is when inflation doesn't go up or down, and deflation is when inflation goes down. Um, I and then there's cycles, right? Market cycles. So you have to understand what market cycle you could be in. And that's something for another day to get into. But you could be in a bear market for a long time because you have um, a domino effect of derogatory links that are connected one with the other. So you could have a consumer credit crunch that leads to a housing crisis, that leads to uh, a job market, a labor market crisis, which leads to a negative GDP cycle, which is when the gross domestic product flips negative in this country, like it already did. Um, you could have an ongoing war, which people think is always beneficial for countries, but it's not necessarily great if you're in a situation where you're in high debt, right? So it all depends what are the factors that are going to play into it. Like, I really do believe that there's going to be a credit crunch. I've been talking about it. I even told you, Kevin, that I think like it's only a matter of time before we need to go short Visa, MasterCard, you know,
Hmm.
and Discovery Financial. I think that we're going to have a serious housing market crash. Uh, I only say that because I'm a real estate broker and I can see the amount of 90-day delinquencies that are starting to happen. And I can see the foreclosure rate in Palm Beach, which is one of the wealthiest communities in the country, you know? And now we have the situation with the tariffs and et cetera, and inflation isn't going anywhere, you know? Bear markets could linger for a while, which is great for long term buying opportunities, right? Because if you have cash on the side, that's when you can just come in and scoop everything up and then you can create generational wealth, but by the time you can do that, you've already exhausted almost all of your funds. So that's the Debbie Downer.
Yep. If you don't day trade, that was actually a really good answer, JP. It's better than the answer I was gonna give. If you don't day trade, are there general guidelines on which time frames are best to use for swings and long-term holds? Would you mainly just use the weekly and then daily to enter?
Bigger time frame.
What?
All bigger time frames for swing trades.
Yeah, for long-term trades, weekly and daily, are pretty good. And then entries could be always found on the 30-minute, but then you have to ask yourself, okay, if I'm getting a long-term trade, I'm pretty sure a few dollars or a few cents won't be the difference in a long-term trade lasting or working out pretty well for me. So then when it comes to swing trades, I've talked about this quite a few times before, but if it's your first time here, that's absolutely fine. So daily is, I don't like looking at the daily as much. I personally like looking at the 30-minute and the 2-hour. 30-minute is my personal favorite time frame because there you could see a lot of trades leading into sentiment. So for example, let me go to, let's see, what was the swing I took today? Johnson. Okay, let's go to Merck. You could see Merck over here. You could see the rally, you could see here on the 30-minute, it looks pretty strong, right? You broke above this level that was prior resistance, and you had to climb up through that. So I personally like looking at the 30-minute for entries and for sentiment, and then I would just check the daily, because again, I only take my swings near the end of the day. I just peek at the daily to see, okay, does this look really good or not? But yeah.
My favorite time frame is the 30 and the 65-minute.
Yeah. What about the 135? No?
The 130, I like the 130. I mean, 30, 165, 130, and 8-hour. I know you like to look at the 4-hour. I don't like the.
No, I don't. I'm not a huge fan of 4-hour. I need to wait for 4-hour, and I'm not trying to wait. The 2-hour at least. The second to last 2-hour candle closes 30 minutes before market close. So I like the 2-hour compared to a 4-hour. So for me, it's 30-minute and 2-hour primarily.
Did you even look at the 1 minute?
No,
Don't lie to me.
I don't look at the 1 minute. Why would I?
You don't even have it on your screen, do you?
I mean, I have the time frame because the default comes in TradingView, but I don't click on
You
it.
can remove it.
How do I remove it?
You take the star away from it.
Oh, okay, there. All right, star's gone. There we go. All right. Next question. No, this is funny. Do you foresee Tesla would ever regain 400 and above? If so, when do you think that will happen? Well,
Not financial advice.
not financial advice. Thank you, JP. I believe in the future in my opinion, Tesla will regain 400, but emphasis on future. Yes, it is coming up on the 200 moving average, and even if you want to look away from that, I mean, what really here is saying that it's bullish at this current price? Look at this weekly chart. The only thing that's going to cause it hesitation and a possible reversal is this range right here. So that means this top of the range is going to be a pretty significant area to keep an eye on. If you're finding consistent amount of buyers and wicks that are happening within this range, then there is going to probably be a push up, and you are going to eventually gain 400. When
Bruh.
do I think? Yeah, of course, Tesla's not going to die off.
No, bro.
It's
Come
not going to die off. Even if you hate the company.
Nah, but bro, you
What?
know where it's going to before it even initiates into a buy signal. Come on.
Well, yeah,
Everybody has the same.
no, not everybody. You might be
Okay.
seeing. No, I'm saying like you and I might be looking at it, but definitely not everybody hasn't. You're probably looking at it probably low 200 range because
No, I'm looking at the 174,657, the same level that everyone is waiting for.
the rich guys, yeah. Where's
We have that level from like, you know from when.
it's the bottom of the range. And
Yeah, that was the level that everybody. We were on that call, dude.
I
That
wasn't on any call
174.
with you.
Oh yeah, no, I'm sorry. On that 174, that's where everybody has a buy order in. I don't think it's gonna go to 174, but if it goes to 174, I'm closing my eyes and just pressing buy. By the way,
Adding on to what JP said, if you guys know Elliott waves, there's a Elliott retracement wave, and the truth is, whenever you have a correction wave, it happens to two in pairs, right? It doesn't just happen one shot down and it just reverses. So what you'll see here is you're probably going to reach the top of the area, top of the zone, and either right now or when it reaches the top of the zone, which is sub 260, you probably might see a reversal back to 300, 360. If you draw out fibs right here, you'll probably see where that bounce will go up to. So let's just say we enter right here, right? If I pull out all the other fib levels, and if you guys don't know fibs, you should look at the fibs video. But what you're probably going to get is a retracement right between the 38 and the 50, which is between 350, and then from there you're going to get a sharp rejection down into the price range that JP was talking about. So yeah, it's probably going to be a dead cat bounce, rejection, followed through to the downside, sub 200s, or around 174 like JP said. You're going to find a lot of buy orders, and that's where it's going to push it back up. Yeah. So
Tesla plays so technical though, bro.
it is. It's definitely. It's definitely a technical stock. That's why I used to love day trading it.
It's like you draw the level and then holds it. I still have the levels that we drew from back in. Jesus Christ, dude. February 2024. I have these levels drawn in. My God. When we were trading in that 153, 160, 167, 173, and then it broke out to 205. Oh
Yeah.
my God. Oh my God, bro. They thought you were a genius.
Okay, dumb question. We're in a bear market, but bank analysts raising prices targets. Why? Well, because they're dumb, bro. Any freaking price target raise is utter bullcrap. It's just market manipulation. Majority of times, it's just so they can feed their own mouths. I mean, look at Bill Ackman. You think that guy's a genius? No, he's just really good at marketing and saying the right things for the right companies at the right time, so he can make a decent amount of profit for whatever trade he's in.
It also depends who's putting out the price target, by the way, yeah?
Yeah. I mean, you probably have more.
I don't believe any price target that JP Morgan puts out.
Yeah, those
You know what I mean?
utter
That's
nonsense.
bullshit.
Yeah.
But RCB put something out, or Guggenheim, or, I don't need to tell you who. Outside of Goldman, Goldman put something out. You don't ask questions. Horizon Kinetics put something out. You don't ask questions. UBS put something out. You don't ask questions. But JP Morgan, Bank of America, Wells Fargo, Truist. Oh, who is a Truist?
JP definitely knows more about that than me, but I'm a douchebag, so I always ask questions. I don't care who the hell it is. I like being wrong because I'm wrong, not because someone's telling me I'm wrong. So I always go according to my trades. They're always going to be saying whatever the hell they want. Some of them might be right, but I'd rather be right because I'm right or because I'm wrong because I'm wrong. But if you want to figure out what banks or firms are better with their upgrades and downgrades, I definitely ask JP. Message him because he has.
Am I the only one that has a 325 level on Tesla?
What?
Do you have 325? Do you have a 325 on Tesla?
No.
You don't have 325?
No. I mean, I don't have any levels. I just have fibs. By the way, sometimes you don't need levels if you have fibs. I just put that out there.
Yeah.
It's true. My 11 years, I haven't been proven wrong. Yeah, so it's basically creating exit liquidity. That's what it is. You guys remember what happened to Bank of America and HIMS, right? Bank of America put out a downgrade because of the Amazon news. What did HIMS do the next day? It freaking skyrocketed. So, yeah.
Nobody cares about Bank of America.
I know. Is there a way to know how much in dollars you're risking when you're using the long short position tool in TradingView? I.e., if I set my risk stop red at a certain level, can I know what percentage of my option trade that is? No, you can't, because unfortunately it's not like futures where it's a static, thing. You are going to be, look, you can, okay. If you're trading a high IV stock, it's going to be even harder to predict. if you're trading a low IV stock, it's going to be a little bit easier to predict. Because if you're trading a low IV stock, what you can do is you can use sources such as an option calculator. You could just search it up and you could, find it. Or you could even use Robinhood because it has an okay option calculator. But I've always stressed that option calculators are deceiving because it does not count, or it does not take into consideration any IV change. And IV changes constantly throughout the day and also from day to day. So that's why it's hard to tell where exactly the option, how much it's going to lose. Let's say if you're used to trading Tesla and you trade Tesla all the time, you could kind of figure out by looking at the IV and the current IV percentile, like, oh, okay, all right, if it drops like $2 down, maybe my contracts are going to be around like negative 30, right? Yeah, so option calculators are great, but again, that does not factor in IV changes throughout the day. So it's important.
I
You
hope my
can't.
contracts are only down 45% today.
Yeah. What's your opinion on using opening range breakout? It's okay.
That's my style of trading when I trade by 15-minute opening range or the 30-second opening range trade, but there's so much volatility in the market that it's hard to predict. It's better to use the 15-minute OR.
How can I start your small account challenge? I'm just doing that myself, so it's all right. It's officially been an hour, 2 hours. Any final
It's
questions?
been 2 hours?
Yeah,
Wow. That took a long time.
yeah. All right. I think we're just gonna call it wraps here because it's been 2 hours. I'm gonna go eat and go sleep. But again, hopefully the answers helped. Again, thank you, JP, for coming on. Thank you guys for coming on. At least you made use of something which people would have to pay money for. So there's that. But yeah,
I'm exhausted, man.
me
You?
too. Dude, I'm
I'm just
fasting.
exhausted. I'm just exhausted of trading. I really want to take a break.
Take a break. What's the point of not taking a break?
Yeah, I know. I just really want to take a break. It's just too much charge, too many consecutive days of looking at the same thing. It's just at some point you just get burnt out. Like I have my swing position. I just want to be in my swing positions and let them do what they got to do, and then just not be too concerned right now. Because I feel like I'm getting to that point where it's just like, oh, you know what I mean?
Get your beauty sleep, for sure.
Yeah.
Take
I'm
that
gonna go to
rest.
bed. All right, I'm
All
out of
right.
here.
I'll see you
Later,
guys. See you, JP. See you.